Jambo, welcome to another session of Kurgateric Finance and Accountancy Tutorials. Remember, if you are not subscribed to the channel, please do so, and you also ring the notification bell. Please also share this video with as many friends as possible so that we can benefit all of us from these free tutorials. We will start with a recap of what we said in our previous lesson, that the ledgers follow the double entry rule of accounting. And we said that the dual concept of accounting states that for every debit entry in one account, it must be followed by a corresponding credit entry in another account. So, and I told you that I use this term so that you do not get lost in the way. The dealer. We said up to here, these are drawings, these are expenses, and these are assets. We say these are liabilities, these are the equity, and these are revenues. We said that the drawings, expenses, and assets, all these have got debit balances. That is what we said. And increasing any of these, the drawings, expenses, and assets, you increase them on the debit side. Decreasing either of these, drawings, expenses, or assets, you decrease on the credit side. That is what we said, right? And then you say liabilities, equity, and revenues have got credit balances. That is what we said. Increasing either the liabilities, equity, or revenue, you increase on the credit side. And vice versa is true. Decreasing liabilities, equity, or revenue, you decrease on the debit side. Are we together? So that is what we said. Still on recap, we said that an account is a page in a ledger, right? So let's say, for instance, this is our ledger page. An account is always inscribed inside here. An account has got two sides, the debit side and the credit side, right? So when I was saying drawings normally have got debit balances, so this is the debit side that I was talking about. And increasing drawings, expenses, or assets, you increase them on the debit side. Yes, they have the balances here, and then increasing, you increase on the debit. Decreasing, you decrease on the credit side. Equity, liabilities, and revenue have got credit balances, right? Increasing them, increase on the credit, you decrease on the debit side. Are we together? So that is what we said as far as the account and ledgers in our previous session concerned. So today we are going to look at an example, the KASNEB exam question, so that you get to understand this issue in depth. So this is Introduction to Financial Accounting, ATD Level 1, question number 1B, that was examined by KASNEB on 30th August 2021. So let's try and attempt this question. Celia Atieno lost her job after her employer closed shop due to effects of COVID-19 pandemic. With her savings amounting to 950,000 Kenya shillings, she started a general supply shop in January 2021. Her transactions for the month were as follows. January 1st, started a business with 950,000 shillings in cash. January 2nd, bought goods on credit from Johnson Traders, shillings 180,000. credit sales, that is on January 3rd, from BD Limited, to BD Limited, shilling 66,000. Swaju Investment, 25,000. Swan Limited, 43,000. And then on January 4th, purchased goods in cash worth 230,000 Kenya shillings. And then January 5th, bought second-hand motor van for 256,000 shillings, paying by check. And then January 7th, paid motor expenses, shillings 12,000 cash. Then January 9th, credit sales to Paris Traders, 24,000 shillings. Calvary Group, 26,000 shillings. Finlay Limited, 68,000 shillings. January 11th, purchased goods on credit from Jones Traders on 240,000 shillings. Da Vinci Limited, 62,000 shillings. January 13th, purchases returned to Jones Traders worth 25,000 shillings. Sales returns from Swaju Limited Investments, shillings 11,000. And then January 20th, cash drawings by the proprietor, 44,000 shillings. Then January 21st, payments made to Da Vinci Limited, 62,000 cash. And then January 23rd, received payments from BD Limited, 66,000 shillings through a check. January 25th, received payments from Swan Limited, 43,000 shillings through a check. Then January 28th, purchases returned to Jones Traders, 42,000 shillings. And then January 29th, purchased stationery, shillings 4,000, paying cash. Then January 30th, which is the last transaction, credit sales to Swaju Investments, shillings 42,000. Calvary Group, 54,000 shillings. So we are required in this question to the relevant ledger accounts and close them as at 31st January 2021. And then you're also required to extract a trial balance as at 31st January 2021. So I think this is a very comprehensive question that at the end of this question, I want to believe you will have understood all that we are talking about in the dealer word. Remember our word? Dealer. So before you start any working on any transaction, it is important to know that the double entry of accounting requires that for every double entry in one transaction, in one account, it must be followed by a corresponding credit entry in another account. That means you must at least identify two accounts that are going to be opened in that transaction for you to be able to obey the double entry rule of accounting, right? So let's move on to January 1st. Started business with 950,000 shillings in cash. So from that transaction, you must identify two accounts that you are going to open to satisfy the double entry rule of accounting. So started a business means that's a capital account, isn't it? Yes, starting a business, that is a capital. So you open capital account. Are we together? And then with 950,000 shillings in cash. So this 950,000 is in form of cash. So you open a cash account, good. So the two accounts are capital account and cash account. Cash account. I want to believe you're getting that. So, and then I want us to feed these accounts. So we are told started a business with 950,000 in cash. So which account is increasing, which one is decreasing? So in this case, our cash account is increasing by 950,000. Not ours, but Celia Tino's account is increasing by 950,000 Kenya shillings. And I told you, assets normally have got debit balances. Increasing asset account, you increase on the debit side. Are you together? So here we have 950,000, right? But what are you going to write here? You write capital account, because this where the cash account is going to complete the double entry with the capital account. So since this is the debit side of the cash account, the capital account will take automatically the credit entry, because of what? For us to obey the double entry rule of accounting, right? We said for every debit entry in one account must be followed by corresponding credit entry in another account. So here you write 950,000, but what are you going to write here as narration? Cash account. I want to believe we're understanding that, right? So going forward, I will not be writing all these narrations, but I'll just be showing the figures. So let's move on to the next transaction. January 2nd, bought goods on credit from Johnson Traders worth 180,000 Kenya shillings. Bought goods on credit from Johnson Traders, right? So I want us to identify at least two accounts in this transaction. So, and remember, this is a credit transaction. When we were introducing accounting, I told you that transactions are divided into two: the credit transactions and the cash transactions. Cash transactions, cash is involved, solid cash. The credit transactions, payment has been deferred to what? To a later date, right? So bought goods on credit from Johnson. So we have purchases account because of goods, right? So come here and write purchases account. Purchases account, purchasing goods from Johnson Traders. So come here and write Johnson Traders account. So which account are we debiting and which one are we crediting, right? If we purchase goods, it means that our purchase account is increasing while the Johnson's account is decreasing, right? And where then are we going to indicate in our purchase account? Remember, goods are kind of goods I've got, they are our assets, right? They have debit balances. So we are increasing our goods account or purchase account by 180,000 Kenya shillings, 180. Since this is debit side, the Johnson will take automatically the credit side, right? 180,000 Kenya shillings. Are we together? So I'm not going to write either. So here you're supposed to write purchase account 180,000, and then here Johnson account 180,000. Are we together? But because of space, allow me not to write that for now. So let's move to our third transaction. That credit sales to be delimited 66,000. It's Swajul investment 25,000. And Swan Limited 43,000. So let's start with identification of two accounts. So we have credit sales too. So first of all, you have sales account. You have sales account, credit sales to BD Limited, Swaju and Swan. So we are going to open an account for each and every data here. So we have BD Limited account, and we have Swaju Limited, and we also have Swan Limited. Right? So our sales account, we are selling to BD, Swaju, and Swan. So which account is increasing, which one is decreasing? Remember, we are selling to our customers. Customers that are buying on credit in a business are known as debtors. And debtors are assets in the organization. And increasing assets means that we are increasing them on the debit side. So each and every customer here, the BD, Swan, and Swaju, will have increase on the debit side of 66,000, 25 and 43,000 respectively. So for BDA 66,000. Our sales account here on the other side, since this is debit side, the sales account will take the credit side automatic. Are we together? And then we have Swaju Limited. Swaju Limited, debit of 25,000. That means the sales account will take the corresponding credit entry automatic. Swan Limited 43,000. The sales account to complete the double entry 43,000. 43,000 Kenya shillings. So January 4th, purchase the goods in cash 230,000. So we have the purchase account here and the cash account, right? So our purchase account is increasing on the debit side while our cash account is decreasing, because when you purchase goods in cash, our cash account reduces. So our purchases are increasing on the debit side. There's the purchase account here, 230,000. Our cash account is decreasing on the credit side, 230,000 Kenya shillings to complete the double entry. January 5th, bought second-hand motor van for 256,000 Kenya shillings, paying by check. So here we have motor van account and bank account, right? Payment by check means payment through the banking process. So we're going to open the bank account and second-hand motor van account. Are we together? So let me open the motor van account here. Then I open the bank account here. So what is happening in this transaction? Our money in bank, the serious Atieno's money at the bank is decreasing because she is purchasing, she is buying a second-hand motor van, 256,000. So that means the bank account decreases on the credit side because this is an asset, isn't it? Remember, all assets have got debit, and then balances, if you increase on the debit, and if you decrease in the credit. So when buying a motor van, this account of bank will decreasing on the credit side. So decreasing on the credit side, 256,000. And then to complete the double entry, this 256,000, write 256,000 on the motor vehicle. It makes sense. When you purchase motor van, this motor van account will increase, isn't it? And you know motor vehicles as assets in the organization, they are non-current assets. So these assets will increase on the debit side. While when we buy through the bank, our bank account decreases on the credit side. Are we together? So it makes sense. January 7th, paid motor expenses 12,000 in cash. So identification of, you have to identify two other accounts. We have the motor expenses account, right? And the cash account, isn't it? So we have motor expenses account and you have cash account. So paying motor expenses means our account of cash will reduce. And given this is an asset, decreasing this account, you decrease on the credit side, right? So we are going to decrease our cash by 12,000 in the name of motor expenses. And then we increase our expenses on the debit side with 12,000 in the name of cash, isn't it? This is an asset. Assets, when you decrease on the credit side. Increase on this other side. So when paying these motor expenses, you decrease on the credit side. And I told you, expenses also have got debit balances. Increasing the expenses, of which like what we've done here, you increase on the debit side. It's making sense, right? Good. So let's move on to next part. January 9th, credit sales. Number one, so we have sales account to who? To Paris Traders, the Calvary Group, and Finlay Limited. So we have sales account. We already have the sales account here, but we are selling to who? We are selling to Paris Traders. Paris Traders account. We have who again? We have Calvary Group. And we also have the Finlay Limited. Good. So let's move on. Our credit sales means that our sales account is going to increase to, where's our sales account? We have our sales account here. Sales account to Paris is 24,000, meaning since this credit side, Paris will take the debit side automatic of 24,000, right? And then you have Calvary Group 26,000. 26,000, Calvary Group 26,000. Then we have Finlay Limited 68,000. Calvary Group debit side 68,000. Are we together? And then January 11th, purchased goods on credit from Johnson Traders and Da Vinci Limited. So our purchase account is going to increase on the debit side. So here we have, so the accounts that are going to be opened there, purchase account, Johnson Traders account, and Da Vinci. So we have purchases account here. So our purchase account is increasing by 240,000 on the debit side, right? And then you have Johnson Traders the credit, because this was debit, the credit side good, 240,000. And then you have Da Vinci again. Do you have Da Vinci in our? No, we don't have Da Vinci, so we open Da Vinci account. Da Vinci account, 262,000 shillings purchases, 62,000, 62,000 on the credit side. I want to believe I'm clear. I'm going slow so that you get to understand each and every point here. So January 13th, purchases returned to Johnson Traders worth 25,000 Kenya shillings. So it is good. It is always a good practice for students to show the purchase returns account and purchase account as different accounts, right? So these are purchases returns. So we are going to open the purchases returns account number one. Purchase returns account, right? So this purchase returns account can also be called the return outwards. Are we together? We purchased some goods and services, those goods, and then we are returning them, maybe due to the reasons that we know well. So we can return those goods, returning them out of the business. So that is why they are known as purchases, or rather return outwards, or purchases returns. So in our case, we are returning to Johnson Traders, meaning that the Johnson Traders account is going to increase on the debit side, while our purchase returns account, or our purchases, are going to be credited. Are we together? So the purchase returns to Johnson Traders. So we have purchase returns account and Johnson Traders account. So this account is going to be credited an amount of 25,000 Kenya shillings, right? And then this account of Johnson, we are going to reduce this balance of Johnson on the debit side by 25,000 in the name of return outwards. Are we together? So I want to believe you're getting that. And then sales returns from Swaju Investments. So Celia Atieno had sold goods to Swaju, right? Yeah, Celia Atieno had sold goods to Swaju Limited. So, but Swaju Limited has decided to return some of the goods, maybe they were defective. So what will happen? The Celia will open an account known as sales returns account, or what is known as return inwards. So Celia Atieno had sold goods, but that customer has returned the goods. So return into the business, return inwards. Are you getting the difference between return outwards and inwards? Great. So let's open an account known as the sales returns. Let's minimize the space. Sales returns account. So sales returns account from Swaju Investment. So Swaju Investment, we had sold to Swaju debit side. So since he is returning, you return by reducing this account on the credit side of 11,000. So since this credit side, we're going to debit this one to complete the double entry of accounting 11,000. Let's move on to our next part. January 20th. Cash drawings by the proprietor worth 44,000 Kenya shillings. So Celia Atieno is the proprietor and she is drawing some cash, maybe for personal use. So we have cash drawings, meaning we have the drawings account and the cash account affected, isn't it? So we're going to open the drawings account. So we have the cash account 44,000 reduction. So account of cash is reducing because of drawings of 44,000, meaning the drawings account is going to increase on the 44,000, which is making sense. From our wording, the dealer, we say that D is for drawings, and we say drawings have got debit balances. Increasing the drawings, you increase on the debit side, what I'm doing at the moment, right? And that one makes sense. So let's move to January 21st. Payments made to Da Vinci Limited worth 62,000 Kenya shillings. Payments to Da Vinci worth 62,000 Kenya shillings in cash. So our cash account is decreasing by 62,000 because we are doing what? We are paying Da Vinci. Where is Da Vinci? Da Vinci Limited is here. So this credit side, we are going to do what? To debit the Da Vinci account with 62,000 Kenya shillings. That means we have paid Da Vinci the whole amount, isn't it? The full amount, sorry. So January 23rd, received payment from BD Limited 62,000 through a check. Received payment from BD Limited. Where is BD Limited? BD Limited is here. So that means Celia Atieno had sold goods to BD Limited. So BD Limited has paid, right? So that payment from BD Limited is going to neutralize this account of BD Limited by 66,000, because that is what the question is saying. And then is receiving these payments through a check. A check is a bank tool, isn't it? So that is bank account. So the bank account is going to increase by 66,000. Are we together? Then you move to 25th of January. Received payment from Swan Limited. Where is Swan? Swan Limited is here. So Swan Limited is paying 43,000. So meaning Swan is neutralizing his account, but Celia Atieno is receiving through check. So the bank account again for Celia Atieno is going to increase on the debit by 43,000, right? Or alternatively, you can say since Swan Limited is taking the credit, so the bank account is going to take the debit automatic. Are we together? So January 25th, purchases returned to Jonesy Traders. Where is Jonesy? Here. Celia Atieno has purchased goods from Jonesy, and then now Celia Atieno is returning to Jonesy goods worth 42,000 Kenya shillings. So returned purchase are known as the purchase returns, and you are going to indicate the same in the purchase returns account and on the purchase account, right? So what are you going to do? You are going to return to Jonesy 42,000, and you're also going to show in Jonesy's account 42,000 on the debit side, right? Good. So let's move on to January 29th. Purchase the stationery worth 4,000 by paying in cash. So we have now this is where most students normally go wrong. This is purchase of stationery, not purchase of goods. If it was purchased of goods, you show that that entry in the purchase account. Purchase of goods strictly. But when it comes to this capital item, like the stationery, so this stationery, you open the stationery account just the same way we did for the motor vehicle. With our motor vehicle account, we open the motor van account, not indicating the motor van account in the purchases. Are we together? So the purchase account is for goods. These are liquid items that maybe will stay in the business for maybe less than one financial year. But for motor van, stationery, and others will stay in the business for more than one financial year. Are we together? So there's difference between purchases of goods that are current assets and motor van and stationery and other non-current assets, right? These are non-current assets, the motor van, stationery, land and buildings, and so forth. They are the non-current assets, and you show the accounts as they are. If it is land and buildings, you open the land and buildings account. If it's motor vehicle account, you open the motor vehicle account. If it's stationery, you open the stationery account. But for goods, you open the purchases account. Are we together? So let's move on to stationery. Purchase stationery 4,000 by paying cash. So you open the stationery account. Purchase stationery in cash. So Celia Atieno's cash account is decreasing by 4,000 because she's paying for the stationery, right? And cash account is an asset, and an asset normally decreases on the credit side, right? And then to complete the double entry, 4,000 in the name of cash, which makes sense. Stationery is an asset, though it's a non-current asset. Increasing an asset, you increase on the debit side, right? That is what I've done. Decreasing an asset, because you are buying something, you decrease on the credit side. That is what we've done. Are we together? So let's move on to our last transaction for Celia Atieno. January 30th, credit sales to Swaju Investment. So you're still selling to Swaju. Swaju. Swaju, meaning Swaju will take the 42,000 on the debit side, and then we have the credit sales account increasing by 42,000. Then we have Calvary Group for 54,000. Is Calvary Group 54,000, meaning the sales account again will increase by 54,000. For the next part of this video, please stay tuned. Thank you so much.